From Barangaroo Studios, this is the COB, brought to you by eToro. Invest in ASX shares with $0 commission.
Good afternoon, this is the COB, all the stuff you need to know about the day in business and markets and, well, fiscal policy, I suppose, as well. I'm Kyle Rodder here with Danny Akuye. Danny, it's fair to say that, well, for a lot of reasons, the budget was important. For investors, though, perhaps not the highest priority.
No, I'm just trying to check in and see how the market closed. Really, it was a bit of a nothing day, wasn't it? It sort of traded down, traded up, traded down, and then traded down again. So I've got, what have we got there? About a quarter of a percentage point fall on the CBO 200. But yeah, I really feel that low volumes again from what I could see, and people really probably sitting on their hands ahead of that inflation, US inflation reading coming out tonight.
Yeah, and that takes us well to the three themes because, well, there's that budget topic that we've been talking about all day, but there's also that whole inflation trepidation perhaps, and we'll just see if we can get that up now. If it is able to be done, doesn't look like we can, unfortunately. But effectively, three themes: budget, inflation trepidation, and well, I suppose we're really just tracking sideways at the moment as we wait for those key figures out tonight.
Yeah, absolutely. In terms of, I was just trying to pull up some of the sectors to have a quick look. So healthcare found some love today. That was about 1%. Whether or not that's completely budget related, oh sorry, I just jumped ahead in terms of those. But otherwise everything really, a little bit of love in real estate, but otherwise everything else in the red. But yeah, you're absolutely right. It is all about that CPI reading in terms of what's expected.
Definitely, and well, we'll get across a couple of sectors now, starting with the banks. And here we go, mixed, and the reason being, of course, we had the NAB go ex-dividend, so that's weighed on the sector. Bank of Queensland, you said as well, was ex-dividend today too.
That was ex-dividend as well. Just quite interesting that the last three banks that reported actually seeing some buying. So it could, you know, Westpac has been a little bit firmer, not so much today, but maybe some investors just capitalising on the weakness over the course of this year and some of those share prices to go in and buy come dividend.
Yeah, absolutely. And well, I mean, it's a message that I've got from a few people that maybe all the dirty laundry has been aired now. We'll see if that happens to be true or not. But nevertheless, a lot's been put out there by the banks over the last week or so. Let's get a look at healthcare now. And you did touch on that being, you know, really one of the few outperformers of the market. We speculated whether there's anything to do in the budget with that, because there was a lot of healthcare initiatives announced, maybe a long bow to draw. But nevertheless, CSL above $300 a share. So plenty of folks out there with that in their portfolio. So always happy to see a 3 in front of that.
ResMed is also ex-dividend, even though that share price isn't up there.
We got to remove that. It's every day. There's, I'm sure, one person having a heart attack thinking the company's gone bankrupt or something. Okay, let's get to sort of some of the equity news. And well, CSR said it will be paying a higher final dividend of 20 cents per share, despite full-year net profit shrinking 19% to $290 million. So that number was 17% higher at $225 million for the year ended March. So revenues also rose 13%. CEO Julie Coates said its building products, property and aluminium businesses have performed very well in what was a very busy year. Flagged a miss outlook for 2024. One that you keep much of an eye on in terms of the building
I was just about to say, it's not one that you really hear about that often. We tend to talk more about Boral or James Hardie, but CSR not so much. Back in the good old days in the building materials era, when I covered those stocks, yes, but not so much these days, no.
Not anymore. What about Appen? Have you got an interest in that? How are you like with
hype
stocks?
No, thankfully, yeah, gosh, how the mighty do fall. Appen, wow, that it just continues to be really a lot of heartache for investors, doesn't it? They've downgraded yet again their revenue forecast, their earnings expectations. And was it stock of the day? It
was stock of the day, and well, we spoke to Daniel Ortiz from Lincoln Indicators and Carl Capolungo from Think Markets as to whether, well, they'd think about buying this embattled stock.
for us, it's probably more of a structural problem with the business model itself. It was always more of essentially a labour hire business, really. If anyone actually had a look at the Appen platform, it was simply, people on it getting paid by Appen to narrate data and, click on the images when it comes up, etc. So it was always really more in terms of a labour hire business. And it seems like that part of the model has really been shifted elsewhere in terms of competition and also potentially cut out with technological advancements. So for us, it's more of a fundamental issue. We wouldn't be near the stock.
When it comes to the technicals, that's speaking to some of the underlying narratives around Appen. But with the technicals, days like this, I think, are really instructive. When we get a profit downgrade like the one we've had, the market is disappointed. Often you're going to get a drop at the open, and then you want to see how the price responds from there. So if we close near the lows today, it's telling you that people have assessed the news and that supply persisted into the end of the session. So at the same time, demand was non-existent. It's not like people were coming in to buy the dip and find the bargain now that prices are lower. That's if we close near the lows. However, if we can push back up and close near the highs, it doesn't look like it's happening on Appen today. It's telling you that maybe the market is interpreting this as, well, that's the last of the bad news. It is time to buy the dip, and we're happy to take the punt. So watch that close. It's not looking good at the moment.
Yeah, so fair to say it was caught up in that bubble a couple of years ago. I think it's fair to identify it as much. It was pretty ridiculous there for a couple of years in that space.
But also structurally, they've lost a lot of their major clients. Yeah. So you've got to remember that Facebook and all those have actually taken away business. So they really do have headwinds in terms of, where the business was 3 years ago. Yeah. Versus where it is now. You wouldn't want to be management, I don't think.
Yeah, not a ringing endorsement from anyone there. Okay, but let's move on, and we'll quickly talk about inflation. Obviously, you wrote your view about it this evening. 5.5%, I think we're expecting out of the States. It's pretty sticky.
Yeah, it does look pretty sticky. They've got lots of challenges over there, though, don't they?
Yeah,
they've still got wobbly banks, they've got sticky inflation, and they've got the debt ceiling. But I guess, too, the question that we might put to our guest today is about the budget and whether or not it is inflationary or not inflationary. Because just doing a vox pop around, it seemed to me that there's a few mixed views on that one as well. Yeah,
okay. Well, great timing to get Mark Gardner in from Macro Capital. Of course, he's live at the desk. Mark, you had some choice words perhaps about the fiscal situation and how it might be complicating the RBA's job off air, but effectively maybe making things a little bit more difficult?
Well, not necessarily more difficult. I think if, it should be played in an ideal world, it should be played as a team game, and you should have your fiscal and monetary policy heading in the same direction and not having a situation where, the RBA, which has copped a lot of criticism, is now going to have to hand down yet another probably unpopular decision. So, look, it depends on your political leaning, I guess. There was where you think money was well spent, but ultimately we need good economies run when governments and central banks are on the same page, not sort of fighting each other. And then not, burning each other at the stake in the public forum as well. So, I would have liked to have seen a little bit more fiscal constraint from the government and just trying to, solve a few problems in terms of, and not go for, polling wins. But, this has been the case for nearly 20 years with the budget. This pattern of bits and pieces get leaked well before the budget comes out. They see how it plays in the public forum, and then they sort of, they mould policy around it. Whereas, I think the leaders past, you just make the decision, you stick by it, and do what's right. But I guess I'm showing my age a little bit there. Expecting politicians to do the right thing. They've got to get re-elected, and I think that's why it's important we don't, you don't go making massive changes to the central bank system. Because someone's going to, at the end of the day, is going to make the unpopular choices. So, if we go and start making the RBA populist as well, well, we end up in a situation where Greece and Italy have found themselves where governments swing back and forth and the voters get more and more and more, and it ends up being an economic sort of catastrophe down the line. So we, there's always been economic cycles. So it doesn't have to be boom and bust, but we should definitely have expansion and contraction. So we can't just have endless endless rise in asset prices all the time. So it's never ended well in any economics book ever.
Absolutely. Maybe moving away from sort of that inflationary discussion and the fiscal impact, was there anything that you took out of the budget for investors of being of any significance?
Not particularly. I think we're pretty middle of the road in Australia. There didn't seem to be any major extremes in there for me. It's not something that I'm generally paying a huge amount of attention to, because obviously there's been a real lack of any significant systemic change for quite a while now. So yeah, it's not there'll be some individual winners here and there, but I mean, you even look at the IVF subsidies from a couple of years ago. We used that as a catalyst to buy into Monash IVF. It's taken 18 months for that to play out into their bottom line. So it's something to maybe flag for for future, to take under consideration for future investment choices. But what you've got to realise is that initial spike that might happen on a sentiment bump's really not going to filter through till next year's tax returns. So you just got to be a little bit wary that there's going to be a lot of water under the bridge between now and the next financial year, where these changes start to come into effect.
As we noted off the top, really, if you looked at the market today, it wasn't a great deal of movement, of course, in the budget or anything of this, or even rates markets pricing in a big impact from the budget on rate expectations. But of course, we do shift our focus now to CPI figures tonight. I mean, pretty meaningful, especially after the Fed guidance that we got last week.
Yeah, and look, if we hit that sweet spot like payrolls did, where it was not too weak, not too strong, we might have a pretty quiet rest of the month, to be honest, because we're looking towards the next FOMC. I mean, that's weeks away. So we have had an 18-month period where volatility's been at fairly high, elevated levels. So it'd be one of those things. I guess they'll be looking at the core mainly overall, and I think that's where the RBA sort of found its justification was. I think we've got one of the higher core rates, whilst our headline isn't quite as high. So and I think it'll be well poured over now that earnings is largely out of the way. So it'll be interesting to see. I think a strong number. Really is going to start to unwind those, early rate cut expectations very, very fast. And so I think that's probably the risk is more likely to the downside. I can't really see any number providing a massive positive catalyst for the market to go on a tear to the upside. Because if we do have inflation fall too quickly, it'll be as a result of more than slowing demand, and we'll start to see a switch to people worrying about recession rather than fearing sort of peak rates. So we are sitting there in that limbo land, and as I've sort of been mentioning, last few weeks just we don't know, and I can't say with any degree of certainty. So good time to sit and watch from the sidelines. There's a few. Macquarie reported last week, GrainCorp tomorrow, Elders next week, IPL. So there's a few little bits of corporate news in Australia, but apart from that, we'll just see how the narrative plays out. The debt ceiling as well, they do love to play chicken with the US economy, and I get the real feeling that they'll leave it till the last minute this time, and if we reach that debt ceiling quicker, like Janet Yellen's saying, then, or if it even comes up faster than that. You could start to see that sort of even further unnerve markets again. So, yet another reason to keep your powder dry.
Yeah, just in terms of an inflation read, if it's hotter than expected, and then you were talking about maybe the futures code changing, do you not think there's a risk, if it is higher than expected, that you actually then see the market going, oh my God, it's another nail in the coffin for the banking sector, and you see that whole regional bank starting to sell off again, and that gyration starting?
Yeah, that's another possible outcome. I think as well with the debt ceiling, it's causing issues in, short-term in the T-bill market as well. So people are already nervous about banks. Could you imagine trying to, you've got this enormous capacity for there to be volatility in the yield curve when the things that are normally very stable. It just adds another degree of difficulty to the whole thing, which is sort of yet another reason why we just sort of, what is the market going to take out of it? I think we're starting to see the tail end of. I think there's been a few predatory shorts in those regional banks, and a few of them have bounced back now, and I think that trade will start to fade out a little bit. And it worked quite well up until a point, but now I think the recent couple that were in they're only in the 20 bill market cap range. I can't remember their names, but they were very small end, but they bounced back pretty quickly. So that those traders and algos will tend to beat at a door until it stops, and now it's kind of stopped. I think that predatory short will probably stop a little bit because everyone's their dirty laundry, as you said, and I don't think there's too many other surprises. But like I said, the debt ceiling adding another degree of difficulty to hedging your debt book. It's just one more reason, one more pothole that the banking sector can fall in. So it'll be interesting, and there could be a narrative either way tomorrow that could switch a week later as well, as they dig deeper into the numbers.
Mark, really appreciate your insights as always. We'll let you get back to preparing for that CPI release perhaps, but Mark Gardner there from Macro Capital. Okay, well, we've really obviously picked it apart quite a lot. What's on tonight? Well, you may have heard it's US inflation, US CPI, but we've also got Disney results too.
And also Airbnb reported after the close in the US, and apparently that was the expectations were very poor, so that stock was trading down. Only because Josh Gilbert mentioned that, but obviously Walt Disney as well. Yeah,
a bit of a consumer narrative there, tourism, and even the streaming wars in there as well. Are you a Disney Plus person, or are you some more of a Netflixer, or do you have a preference?
I have Netflix.
I'm a Netflixer as well.
My son has Walt Disney Plus. It's a hangover from his teenage youth years.
Yeah. Well, again, it's another thing that's reasonably sticking our streaming preferences, I suppose. And off to the leaders and laggards we go. Let's have a look at the leaders to start with. As we always do, focus on the positive. And there you go, Paladin Energy up 8%. Are we betting on nuclear? What's going on there?
I have no idea. That was my hunch. Ditto, Lynas continuing to feel the love after they got that extension from the Malaysian government. I do know lots of people like what's going on with Life 360, and I think they have their results coming out next week. And we do know that Telix Pharmaceuticals has very much been a popular with investors, but it might be a bit of a stretch to say Paladin and Lynas are running off the back of the budget. I don't know if you found anything there.
In terms of high trading volumes, share price for this, another share price movement, but luckily, not too much that I can actually see. No news out of the company in particular from what I'm reporting.
Story, as in if we're going down the hydrogen route.
Yeah, right. Underlying uranium prices up.
Right, uranium.
Luckily, we've still got Mark here on the desk to give us the expert pointers there. But there you go. Okay, that's just an interesting story, just in general with nuclear. Did I say that right?
I say nuclear, but yeah.
I got told the only time I ever got told off from someone who's watching me on telly was when I said nuclear wrong.
Oh, okay.
I try and be very careful now. Anyway, moving on to the laggards, and again.
There we go. Ex-dividends. The top two, Bank of Queensland and NAB, off 4% and 3.8% respectively.
Yeah, so keep an eye on that over the next few weeks, of course, because there'll be a few more banks going ex-div, a few other companies that could weigh on the market as well. We already spoke about CSR, the building material space, which, again, you covered in the past, but clearly not necessarily on our radar quite as much today, although did talk of potentially weaker conditions in 2024. So that's always a a bit of an omen, of course, not a great one. BlueScope Steel down 3.5% for the session. Champion Iron also down 2.6%. Actually, did you see what happened with the material space today? We'll get it up now, but it seemed that
it was off a bit, wasn't it?
Yeah, off. So we've got materials off by 0.5%, energy off by 0.5%. A bit of a mixed bag, really. Telcos and financials.
It's a very, very muted response to the budget, which is probably not unusual because there wasn't really, a lot in there per se when it comes for the investment community.
Yeah, and there never is. I think the only time I've ever seen, in my very short career, of course, the markets respond to a budget was when it was the emergency settings of the early pandemic, when we're all just waiting for the government to just basically say
throw money at us.
Yeah. Are we all going to go bankrupt or not? Oh, good, we'll buy some stocks. But there we go. That's your laggards there, and the market has finished lower for the day, it has to be said too, down 0.12% on the ASX 200. Okay, and no less, here is the small cap names that we like to go through too.
Alligator Energy, that's a new one to my universe, 4 cents. Up 17%.
No, I don't know, is that far north Queensland or something like that? I don't
know.
Uranium. There you go, another uranium name there as well. So some of the uranium names are really performing well on today. Appen, stock of the day.
Having a shellacking.
Yeah. Not so good. It wasn't always a small cap, was it?
No. It was up there with Altium in terms of, lots of investors were in there.
Yeah, okay, well, fallen angel, perhaps. We'll see. Only time will tell, of course, but, Danny, I think we've picked apart that CPI figure to an inch of its life. All there is to do now is wait for it to
Until
come
tomorrow,
out.
then.
Until tomorrow, indeed. Remember, you can catch up on all the latest views and interviews, and of course, our big budget coverage throughout the day. There's a special rail on the website and the platform that you can go to there. Otherwise, well, strap yourselves in. We'll see you tomorrow morning.
Cheers.
The COB is brought to you by eToro. Invest in ASX shares with $0 commission.